What's up, everybody? It's Professor Reiko. This video today is going to deal with stock dividends and stock splits. So our last video kind of went through, our cash dividends, property dividends, and liquidating dividends. So this one we're going to walk through stock dividends real quick, and basically a stock dividend. So kind of combines both parts of the chapter. So if you think about it, it's still a dividend. Okay, so it results in a decrease in retained earnings. But we're also issuing stock. So we're going to have an increase in paid-in capital because we're going to end up crediting common stock and possibly crediting additional paid-in capital as well. All right, so we have two types of two types of dividends. The small, where it says here 20 to 25%. I typically just tell my students, let's make 25% the cutoff. All right, so small stock dividends are at fair market value. Large stock dividends are at par value. All right, so let's make sure we remember that. That's kind of one of the main differences. All right, so we have assume that XYZ has outstanding 10,000 shares of $10 par value, common stock, retained earnings of 500,000. Okay, so real quick, let me stop here. Notice this is outstanding shares. All right, so let's just refresh our memory from all the treasury stock discussion. Remember, the difference between issued and outstanding is treasury shares. So remember, issued means it has been sold. Outstanding shares are shares that are still in the hands of shareholders, okay? So the reason we don't use issued, assuming they're different numbers, is because that would imply that we are paying ourselves, as we hold treasury stock, a dividend. So we wouldn't pay a dividend to ourselves if we had treasury stock. So we base our dividends on the outstanding shares because those are the shares still in the hands of shareholders. So make sure you're clear on that because that's something that could trick you up depending how it's asked on a test, right? So outstanding shares are what drives the dividends. All right. They have a 10% stock dividend. That means they would issue 1,000 additional shares. Basically, how you do that is you take the 10,000 shares outstanding times 10% equals 1,000 new shares. Okay, so I provide the number here, but you should be able to do that math. All right, so the fair value is $12. Okay, so remember, we want these recorded at fair market value. Okay, so when this dividend is declared, all right, we're going to debit retained earnings. All right, and then, so remember, fair market value, 1,000 new shares times $12 per share, so that's $12,000. All right, now look, we haven't issued the stock yet. We've just declared the dividend. So we use this account, common stock dividend distributable. Okay, and that's going to be for the par value of the stock. All right, so I kind of think of it just as it's an equity account. Okay, so it's an equity account. That's why it's a credit balance. I kind of just view it as a holding account. It's just holding the spot until we actually distribute the stock. All right, we'll see that in our next journal entry. And then everything else goes to additional paid-in capital common stock. Now, as I said earlier, I believe most of the books now use paid-in capital in excess of par, which means the exact same thing. This is just a lot easier to abbreviate when I'm writing it out. All right, so let me just write this over here. So this is when we declare the dividend. All right, let's scroll down a little bit here. All right, when we issue the dividend. All right, so now we're going to take this common stock dividend distributable account off the books, all right, 10,000, and then we're going to issue the common stock. And remember, common stock always goes on at par value, right? So that is a small stock dividend. One thing to note, like I said, this right here is an equity account. So if you were to close your balance sheet before, like in between these two dates, then common stock dividend distributor will just go into that paid-in capital section with your common stock and all your additional paid-in capital accounts. So it would be added into your equity section. All right, now if there was a 40% stock dividend, all right, so that's so this would be considered a large stock dividend. All right, so if we have 10,000 shares, so remember once again 10,000 shares outstanding times 40%, okay, so that would be 4,000 new shares. All right, so remember this is recorded at par value. So when we declare it, we would have retained earnings, and it'd be the 4,000 new shares times the par value. So remember, if we go back up here, we can see that the par value is 10. So now we don't care about the $12 market value. So this would be times $10. All right, so that would be 40,000. Oh, I didn't need the equal there, sorry. 40,000. And then we'll still have this common stock dividend distributable account. And that's always at par value. So those two numbers equal. So when you have a large stock dividend, you won't have any additional paid in capital. And then when we distribute it, we're going to take this account back off the books, just like we did in the first journal entry up top there, or in the small stock dividend, and we're going to issue the common stock at par value. All right, so that's your difference between your large and your your large and your small stock dividend. All right, so stock splits. Okay, so stock splits are basically we're going to increase the number of shares authorized, issued, and outstanding. Okay, so and then but at the same time we're going to have a proportionate reduction in the par or stated value of the stock. All right, so at the stock split, there's no journal entry. We're essentially just rewriting. So in our description of a stock, remember, we have common stock, we have so many shares issued and outstanding and authorized. So let's assume this number was 10, this number was 4, and this number was 4. Okay, and let's assume that the par value was $1. All right, so if we did a 2-for-1 stock split, all right, so really what's happening is if you own a share of my company, you're giving it back and I'm giving you 2 shares. All right, but you're not paying for that, so your investment hasn't changed. So really, if you think a better way to maybe think about it is take your stock, rip it in half, and now you have 2 shares. Okay, you have 2 shares, but they're basically cut in half by value. I mean, if your stock was trading at $100 and they did a 2-for-1 stock split, it would cut that price to 50 and then start trading again. Okay, so you can see it doesn't really change your investment, and it really doesn't change our equity either. So the way this will work, so if we had 10 authorized, when you wrote out your common stock, it'd be common stock. So instead of $1 par, all right, so we now have we have 4 issued and outstanding and 10 authorized. So if we doubled that, so what would happen here is it would now be 50-cent par value, and we would have 20 authorized and 8 issued and outstanding. And so if you notice, if we're doing the balance sheet here, 8 times 50 would still be $4 added in the equity section, which is the same as 4 times 1 over here. So it doesn't change, but our description, how we write things out, does change. But the main thing to remember is there's no journal entry. So if you get that on a bigger problem on the test, and your problem's asking for journal entries, just put no journal entry required, because sometimes they may be trying to trick you up and see if you're going to write out some sort of journal entry. Okay, so if it's just a straight up stock split, there's no journal entry required. All right, so this gets us through stock dividends and stock splits. And then we've got, we'll talk about the statement of stockholders' equity. I believe that's our last video. And then we'll be done with this chapter. So hopefully this is getting you through equity fairly well. Hopefully this will help you come test time. So please subscribe to the channel if you're enjoying it. Please share with your friends. Hopefully it will help them out as well. And I will see you next time.